And now we pivot to my favorite topic of Asia. And we're going to kick off just before we go all the way over into Asia. We just wanted to touch on some Eastern Europe side, and Russia is the key one. Because when you look at Russia, obviously there's a lot happening with protests. There's some discord within the country. Then you look at what has happened in Syria, and recently Israel was able to bomb several Iranian manufacturing plants in a very secure area, and that's we've said it time and time again. Israel is allowed by Russia to strike at will any Iranian and Syrian assets they want, as long as they don't target Russia. Or Russian assets. And if you look at just the equipment that Syria and Iran have to protect their assets and equipment, it's minimal. So that's why it's been at will. And two big attacks happened, which took a big chunk out of some of the manufacturing capacity for Iran in terms of, or Houthis, if you will, in terms of their capacity for missiles and equipment and guns. But the reason why I say that is because there's also these issues with Russian income problems. So we saw the decline in Russian income accelerate in the first quarter. So disposable income continues to fall. And if you look at the year over year, it's given it was a higher comp, but still the pressure is there. And if you have a populace that looks at the price of Brent, looks at what is happening, but they don't appreciate that Urals just aren't trading for what the rest of Brent is. And that, you're looking at discounts. So you're seeing that Russian exports are at all-time highs, or at 13-month highs. Ural pricing is at 12-month lows. And when you look internally, you see that there's a huge increase in inflation, which is why Russia is trying to kind of stop or at least slow some of the export of refined products to help supplement some of the price increases. Again, these are things that create this strife or destruction that, when you look at, well, why did Ukraine happen? Why did this? These are the reasons. It's look at the right hand and ignore what the left hand is doing. And that's where they're trying to distract and generate unity in the face of a problem, a struggling economy. And as one of our producer was saying, there's fewer means of supporting the populace. You look at the developed world and even parts of India and other, they've created means of supporting the populace, and we don't have that amount. And a couple of weeks ago we talked about how Putin has opened up the sovereign wealth fund to help supplement. And I think this is some of those things that are happening to try to ease some of those problems. Because, you might say, why do we talk about Russia right now? It's like, well, they're 13% of global oil supply. It matters, and it matters more and more. And that's one of the reasons why we want to look at it so closely. But when we look at PMIs, speaking on the EM side, emerging market PMIs remained in expansion through winter, but significantly underperformed the developed world. And this is not something that we see slowing down. They're the ones that are not seeing, are struggling with vaccines. They're the ones seeing some of the biggest increases in COVID cases. And that is the residual problem when you're starting to look at manufacturing and getting some sort of normalcy back. Where services is going to stay weak, tourism is going to be a problem, and those residuals will stay through the system. So the other side of the equation, when you think about Russia, China, and some of the implications, the EU is now officially suspending its efforts to get member states and the European Parliament to ratify an investment deal with China, citing an interview with the bloc's trade commissioner. He said the current situation with the EU sanctions against China and the Chinese counter-sanctions make it difficult to ratify the agreement. Remember, they have that trade deal that they were supposed to pass. Unlikely this is going to happen. And that's why when you look at the falling into the fold and the pressure that's going to remain, these are the issues when you consider emerging markets and China and India. These friction points, especially with China, are going to impact the Chinese economy. Because if you don't have free trade, if you have a tit for tat trade war, this is where you're going to see the residual slowdown that just is going to struggle to close the gap, which is why we talk about credit impulses so much, because at some point China is either going to have to accept a slower growth or they're going to stimulate with credit. And that's why we look at that so closely to see if there's any change in policy. Now, the other issue is looking for work. India's jobless rate increased to a 4-month high in April. That will only get worse in May when you consider what is happening right now with COVID and the restrictions that are hitting as COVID continues to rip through the country. Now, this is also coming on the back end of Das, who is the central bank's governor. He came out and essentially said what they're looking to do to support India through monetary policy during this time period, which is why we're going to continue to look at inflation so closely, because inflation could really see a big step up. So our RBI to buy 350 billion rupees of bonds under the government securities acquisition program, which is the QE, on May 20th, sees outlook highly uncertain and clouded with downside risk, but doesn't see a major change to inflation forecast. This is the biggest issue, because gasoline demand has fallen, as we talked about in the EIA show, and we're just, even though demand has fallen, prices have stayed flat, which is, again, speaking to inflation concerns. And that just means that they're keeping their forecast between 2 to 6%. They're okay with it getting to 6%. They'd like to not see it get above. But as they get up to 6%, I think we're going to see some sort of action adjust. Central bank allowed lenders to dip into their floating provisions to set aside money for bad loans till March 31st, 2022. Small businesses can avail a fresh loan recast, provided they weren't part of a previous program last September and were servicing debt regularly as of March 31st. The RBI will provide separate liquidity of up to 100 billion rupees, 1.4 billion, via 3-year repo operations to small finance banks to lend to poor borrowers. So you can see that they continue to push through additional stimulus measures to try to support activity, to try to see some of this come through and see some of that benefits that will remain in the system in general. So when we look at China, and this is something that we've already talked about with Chinese activity, non-manufacturing PMI for April came in where it was expected to be at 56.1, came in at 54.9. Manufacturing was expected to be at 51.8, came in at 51.1. Composite, net came in at 53.8. With the Caxton coming in at 51.9 versus the expectation of 50.9. So there's an inherent slowdown. Again, it's not huge, but it is a slowdown in general, especially on the manufacturing side with the headwinds persisting. So now let's take this a step forward and look into May. So China recorded about 230 million tourist trips for the Labor Day holiday, which is up 119.7% year on year and up 3.2% from pre-pandemic levels. So when we look to pre-pandemic, it was up 3.2%. Domestic tourism revenue rose 138.1% year over year, not surprising, but was only 77% of pre-pandemic level. And this is coming from people still traveled. So we had travel, but it was at a lower rate where sales, and you had sales discounts, you had other types of discounts that, again, ate into some of that growth, which is going to point to what happens with that non-manufacturing PMI. And this is supposed to be the surge period. We're supposed to see more buying right now in May. And so far, we're up to a very slow start on a total revenue level. So the numbers, the amount of stuff could be increased, but because of sales and initiatives and incentives, it's actually well below. Which is why when we look at some of the data points, you can see that there's been some stabilization and actually now some slowing, which leads to what is going to happen with Germany, what's happening in the global economy as we see some of these slowdowns persisting. Then when we look at construction and raw materials are at risk, this is when we look at credit downtrends. So when we look at credit and fiscal impulses, you can see that big move down, and construction and industry typically tend to follow kind of where these are going. And when you look at what the government is saying, they want to target some of this infrastructure building. They've already canceled some or either canceled or paused some infrastructure projects to essentially try to, again, pull back on waste, cut down on debt. So then when you think of the Chinese broad money M3 impulse, so M3 is coming down as we keep talking about liquidity coming out of the system, getting pulled down, that normally pulls down some of the raw materials. Now, it doesn't have to pull it all the way down. You can see 2010, those surge. But this is going to be the headwind. At what point does the market recognize or see some of the slowdowns that are going to be the implications of where future pricing is going to be on raw materials? So then taking this to a different level on China credit impulse, 12 months change versus global manufacturing PMI, new export orders. We've already seen the roll, and that's why when we look at global manufacturing PMI, this is the overall level. So it's only 15% of Chinese GDP, 16% of Chinese GDP, but on a numbers level, it's huge. And if we're seeing some of this roll on export on credit impulses, we expect to see some of these new export orders also start to roll down. Now we are getting some supply chain shifts, so it's pivoting more into other areas like, as we said, Taiwan, Hong Kong, Vietnam remaining the big bright spot. So similar to previous peaks in global economic momentum, China is leading the business cycle lower. The continued deterioration of the China credit impulse is setting the stage for a big shift in macro starting in the second half and possibly lasting well into 2022. There's a lot of ways this can adjust. I'm not saying it can't. It's just based on the way this is progressing, it looks like the roll is starting and that we're going to see some headwinds. And these are those pressure points that we continue to look at that are originating in Asia that, again, are kind of missed a bit by the broader market in terms of pressures that remain in the system. So then when we look at pre-pandemic growth versus actual growth, when you look at GDP, industrial production is the one that remains under duress going forward because we're seeing some of that industrial production slow, while retail sales and fixed asset investments continue to shift down as they try to tackle, not on the fixed asset investment side, there's a significant amount of debt that they're tackling, and retail sales is the one they want to get back up. But based on what we've seen so far in the Labor Day spending, it's just not there. And that's where the biggest concern is going to reside, especially as we look at the friction that is increasing not only just with the US, Australia, and other parts of Southeast Asian nations, but now with Europe. So then when we look at the GDP forecast, this is using Bloomberg Economics. This is looking at the consensus forecast, so you can see where the consensus is and where things shift. I still remain at a lower end of the spectrum and think that not to say that it'll be real, but we're very likely to come into that 6.5% that they've been targeting or softly targeting, or a minimum of 6%, because there are a lot of headwinds, and without a real pivot or move higher, it's unlikely to see this continue to progress in a positive fashion. And that leads us to the amount of debt in the system, speaking to what are they trying to accomplish. So the goal is to reduce debt in 2021 from 2020. And you can see that they've made pretty much no progress. And it's going to be slow. And if you look at SPBs or special purpose bonds, the allotment given to the provinces are only 10% below 2020. So there's still a lot. They're just trying to do it gradually because the system is so levered, and it's continued to get more levered as it approaches that wide range of percentage to GDP. So then when you look at China's population, the peak is happening much sooner than expected. Now, they came out and said that they posted a positive growth. That number's been thrown into question. But regardless, it's getting much closer to the peak versus what expectations were. And this is the forecast from the UN. where it was supposed to peak at closer to the middle of 2020, closer to 2025 into 2030. But it's actually happening much sooner, which is a bit bigger problem, as the U.S. has the lowest growth rate since 1979, which is something we'll talk about in another segment. But again, this is something that is going to become a bigger concern for the Chinese government, that they're going to want to try to incentivize having additional children, and that's why that rural push remains that big pivot. Now, when we look at South Korea, this is the CPI going back up. So when we look at inflation in general, inflation is being driven by a large amount of different pivot points throughout the system. And that's where we continue to see some of this pressure in general. So exports remain elevated year over year. Imports, like you look at Thailand, up 15.8%. The imports, exports remain fairly strong. South Korea, the exports were expected to be at 42%. They were up at 41.1%. But imports were expected to be at 29.6%, up at 33.9%. So that import push just speaks to the growth that remains, but it's coming from somewhere. And it's the shift from China, which is something that is going to become a bigger problem when we're looking at the underlying market dynamics and what does that mean going forward. So then when we start looking at other inflationary pivots, the inflation continues to be fairly stable and strong pretty much across Asia. Now, it's either coming in at estimates slightly above, slightly below, but all of them are pointing and indicating to a higher inflationary push, which is going to increase the cost of exports, increasing the cost for the local consumer in the US and in other regions, especially if you think about Europe, buying raw materials, semi-finished goods. Again, this all reverberates through the system. So then when you look at the components of South Korean GDP, the exports of goods and services has shifted higher. So when you look at imports, private consumption continues to deteriorate, not deteriorate in a big way. As you can see, it's just flat. And they're relying more and more on exports, which is, again, speaking to that pivot over, and they're getting more product and more activity from people shifting from China into the South Korean supply chain. And when we consider the supply chain issues, it's also a supply issue in terms of supply chain supply. So when you look at Chile has increased or tried to increase their copper production, especially when you look at copper at $10,000 futures pricing. Again, there's a lot of reasons to try to get this production back online, but they've been hit with different strikes and different other issues. And as we talked about with the limitations of droughts in the region, shrinking some of the river levels, again hitting into some of the supply side or supply chain push. Now, China's population. Now, this is the Financial Times. They got a number that said it declined. The official number said that it was a slight growth. Again, it's regardless to say there is a shift down, and that's why urban population is the one that the urban population is the shift. Rural is the one they want to grow. So if you look at the rural side, that rollover is the one that they're trying to stop and arrest and actually push higher by investing in rural connectivity, incentivizing companies to move out, trying to get more people and invest money there to, again, get some of that growth and also generate that local consumption to replace some of the consumers that they're losing abroad. So then when you look at India, the interest expense, this is just showing just how high the interest expense are as a burden to the government. So then when you look at new debt issues, new offerings, the interest rates are, when you look at our 10-year, which is typically a good bellwether, the prices are going up. And now if you look at COVID impacts, GDP slowing, and now inflation concerns coming back, it's unlikely to see these rates coming down, which is just going to continue to be an overhang as they try to borrow to not only use fiscal stimulus, but also monetary stimulus. Because if you remember, the Indian deficit is the largest it's ever been, and for that stimulus that is going to become an overhang. Now, just to wrap up, U.S., China, India. So quietly, China has actually increased some of their assets along the disputed lines in Ladakh, and that's going to be one to watch as we go further into the spring thaw. We've already had a terrorist activity in Kashmir. It was fairly small, but again, the spring thaw is when a lot of this starts to ramp up. So the China-India one is going to be the biggest one to watch. So I know we covered a lot of data as we always do, a big focus on inflation and supply chains. If you have any questions, please let me know. People have reached out to me on LinkedIn, on Twitter, as well as YouTube comments, and we always like the interaction and the back and forth. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.